QuickBooks Online 2021, reversing entry related to accounts receivable or revenue or sales with the help and use of Excel. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our Get Great Guitars practice file. We're going to be opening up our reports up top by duplicating the tabs. First off, we're going to go up to the tab up top, right click on it, duplicate the tab. Next, we're going to do that again, right click on the tab up top, and once again, duplicate it. We're going to be opening up then the profit and loss and the balance sheet. Let's start off with the P&L down on the reports on the left-hand side. We're going to be opening up the P&L, profit and loss, income statement. Range changing it up top, ending at 022821. Running that report. Hitting the run report button to do so, closing the hamburger, holding control, scrolling up just a bit to get to that 125. Next report to the left, we're going to open the reports down below once again, this time opening up the balance sheet. The balance sheet report, range change up top, ending at point of 022821. Run it, close the burger. And in the prior presentation, we entered an adjusting entry related to the accounts receivable and sales, in essence pulling an invoice that was entered after the cutoff date, but for which the work was done before the cutoff date, and pulling that information back into the current time period by entering a journal entry in order to do so. So right now we're going to look at it in Excel and think about basically the reversing entry. We have a problem now, of course, that being that we have an invoice that was entered after the cutoff date, and then we entered it basically before the cutoff date, which means that as of 3/5, which is the date of the invoice, we're going to have it in there 2 times. How do we fix that? We're going to do a reversing entry. We do a reversing entry the day after the cutoff date. And you might ask, why don't I do the reversing entry on day 3/5? Because in other words, if I go to the profit and loss, and I run this report for, let's make it going up to 030521, run that report. The invoice we're talking about, if I go then into the sales and products, scrolling down, we're looking at this invoice that was entered, and it was entered on 3/5. So why don't I do the reversing entry as of 3/5? Because if I don't, then it'll be wrong for like 4 days. I should keep it in there up until the point in time the invoice is there. But remember that our concept is to make a difference between the cutoff period when we make the financial statements correct and the accounting period. And I want all my reversing entries to be as of the same date, and then make the adjustments periodically, sacrificing the fact that we will not be perfectly correct during the month. For some items, we'll have some timing differences, and those will be then adjusted for periodically at the end of the month in this case, or the end of the year in some cases. Let's go on back to the income statement. Let's see this on the good old Excel worksheet here. So last time we did this adjusting entry. This is the adjusting entry. When you think about a reversing entry, the easiest way to think about the reversing entry is just to take exactly the adjusting entry and reverse it. And this is if you take accounting courses and you have questions about a reversing entry and things like that, or credit memos, for example, we had a similar kind of discussion, then you don't want to try to think of the reversing entry in limbo in and of itself. You don't want to like just try to think unless it's like a practice exercise and you're trying to get really advanced at it. But you don't want to just try to visualize this backwards. You want to visualize what a normal invoice journal entry would be, write it down, and then do the exact opposite for the reversing entry. And that's basically what we'll do here. So we entered the adjusting entries in this column. Then we have the reversing entry columns hidden up top. So now I'm going to unhide the columns. I'm going to unhide the columns up top by going to the right. I'm going to select column I to M. Columns I'm. And then right click and unhide. Unhide. So there's our reversing column. So now we're in the reversing column so that we can make the change. And remember that this column reflects a change that's going to happen in the following day in March. So I'm going to call this then a reversing entry. We probably should say reversing journal entry. And let's keep it like that. Reversing journal entry, let's say. And then this is going to be exactly the opposite. Now, I'm not going to try to rearrange the order. I don't care if the debits are not on top or anything like that. I want to make it as easy to see as possible. So I'm going to put the same order from top to bottom and just change the debits and credits. That's the easiest thing to do, in my opinion. And I'm not even sure it's opinion. I think it's just fact, you know. It happens to be my opinion, but my opinion is oftentimes the actual fact of the matter, as far as I can tell. No. But in any case, there it is. There's the reversing entry, and then I'll skip a line. We typically do this second piece as a separate entry, or it's easiest to see that way. It's easy to think about it as a separate entry, even though it's connected when we think about the journal entry on a perpetual inventory system for an invoice. And that's basically it. So what's going to happen then when we reverse it? Well, it's going to be the opposite of an invoice. Accounts receivable is going to go down, and then we're going to decrease the sales, and then we're going to decrease the sales tax. We're going to decrease cost of goods sold, and then we're going to increase the inventory, which should be a debit. And that's going to be our transaction. We have the same kind of difficulties we saw before, in that the accounts receivable, when I record this in QuickBooks, will give us a problem because I'll have to have a customer related to it, or QuickBooks won't let me record it. The sales tax is something that we don't want to mess up. The sales tax is down here. We don't want to mess up the sales tax line item in QuickBooks for the little widget sales tax that they use. And the inventory also has a subledger that we want to make sure reconciles after having entered this transaction in QuickBooks. We don't have those issues in an accounting problem, in like a book problem, or here in the Excel worksheet, because we don't have those subledgers, but we want to keep them in mind, because when we go back to the accounting department, we don't want to mess them up by messing up their subledgers. So we want to keep those things in mind. So I'm going to then select these items. I'm going to select the first one, make it green, just to represent we are entering that one now. You might want to hide the first two tabs to make sure that you don't accidentally enter it into the adjusting entry column, because we want to enter it in the reversing entry. So it might be easier then to hide column G and H by selecting them, right-clicking on them, hiding them, so that we can know that we're going to be entering here into this blue area. We got the accounts receivable, so I'm going to go up to the AR. I'm going to say equals and reverse out this 399. So that's going to make it go back down there. And then we've got the sales, the income down here. So I'll go on down to the income. Going to record this. This is going to be equal to the 380. And then we've got the sales tax, which I'm going to record in a separate account. And if you're working in an accounting department and you're recording this information, you probably still want to set up basically this separate kind of account, so that when you give this information to the QuickBooks users, then they'll know to set up a separate account and not hit their sales tax account. See, we want to make it as easy as possible to enter this data into the QuickBooks system. And so if you want them to set up another account, you don't want to be like, well, in that one, you might want to set up another account, because if you don't, you're going to have this problem because of the sales tax widget and whatnot. It'd be best if you could set up another account and foresee that problem. So then we're going to have that item. Then let's ungreenify this one. We're going to ungreenify this one so that we can, and we're going to bluify it, and then we're going to greenify this one so we know where we're looking. We're looking at the green one. And then the cost of goods sold is down here. We're always looking at that nice green, and that's going to be the 304. And then we've got the inventory up top. Inventory up top should be here. It's going to go back up. So this is going to be equal to, and then we're going to pick up the 304. That should then put us back in balance down here. So we got the green zeros on down below. And then if I think about, this is where we stand as of the cutoff date for an accrual basis at this point. And then we basically reversed it back out. This is where we stand as of March 1st if we had not closed out anything. So we still have our income statement here, but we've reversed out then these items. And then this would be our post-closing income statement. So now we have the income statement that has then been closed out, and these are the adjustments that we have to it, meaning this is kind of like our starting point before the accounting department does anything. So before the accounting department does anything, due to this journal entry, we've got a negative income account in here now, which is funny because this should normally be a credit, and now it's a debit. Why would that be? Because we pulled the income back into the prior period, and although you shouldn't have a negative sales account, negative income, once they enter the invoice, which happens on 3/5 on March 5th, then this will net out against the actual invoice and it will be back down to 0. So this will be wrong for 5 days until they enter the invoice, which will net it out to 0. And we already pulled the actual sales item into the prior period. It's recorded in the prior period income that we recorded with an adjusting entry. Same with the cost of goods sold. This is a negative cost of goods sold. Negative expense shouldn't happen. Why? Because it will be correct once the actual invoice hits, which happens on March 5th, and it'll zero back out to 0 at that point in time. So we're sacrificing 5 days of funniness, it being kind of like wrong, because we want to make it as easy as possible for the cutoff between the adjusting process and then the accounting process. And to do that, we sacrifice some non-conformity to the accrual principles in the middle of the time period, in the middle of the month. So that's what we have there. If I unhide then from F to I, I'm going to unhide from F to I, right click and unhide these items. Then we can see the full process here. So we had the accounts receivable. We adjusted to increase the accounts receivable for the cutoff period at the end of February so that we then include the invoice. Then we reversed it back out for March. So now it's back out for March in either one of these. The balance sheet items will be the same. And then we're going to say then inventory. We decreased the inventory because we recorded the invoice for our bookkeeping purposes. So there it is, decreased as of February 28th, the cutoff date. And then we put it back on the book, so we're back up top for 3/1. Again, no change whether we're talking about 2 months in a day, or whether we're talking about just March 1st when we're thinking about the balance sheet, because it's a point in time. Sales tax, we decreased the sales tax, so this is where we stand as of the cutoff date, correct for financial statement purposes. Then we reversed it for the first day after that, so that once again we're back to where we stand for the first day after. And then we're going to go down to the income accounts for revenue. Revenue, we increased the revenue because we pulled the income back into the time period in which it was earned, even though the invoice wasn't entered until after the cutoff date. Then we reversed it back out, so we're back to the original point here. And this is what we would be at if we're talking about an income statement, temporary accounts, that have both 2 months and a day included, as opposed to if we're talking about only the day of March 1st, the starting point before any activity has entered post-closing, trial balance for February 28th or March 1st, and then our one reversing entry being the only activity. That would be the 380 negative income. And then if we're talking cost of goods sold, we reversed the cost of goods sold or enter the cost of goods sold. We increased it for the cutoff date, then reversed it back out. This is where we would be at if we're talking 2 months and a day of March 1st. This is where we would be at if we had a post-closing trial balance as of March 1st with the only activity in it, our reversing entry related to this invoice that we have entered. Down below, we can see the net income. This was the starting point on the net income. These are the adjustments that we have made to it thus far, up to the blue here, up to the equity. And this is where we stand at this point in terms of the financial statements. Then here's our reversing entries that we have entered, which have an impact then if we're talking about 2 months in a day, not having closed out the income statement for March. And here's where we stand if we had closed out the income statement post-closing trial balance here, with the addition of only the reversing entries on the following period, that being March.